My series of videos has been explaining all year why the likes of Tesco and the rest of the already depressed retail sector were facing a perfect storm of rising Brexit producer prices, falling consumer disposable earnings, whilst at the same time continuing to hemorrhage customers to the discounters, all of which would culminate in increasing pressure on profit margins and balance sheets, which ultimately warns to expect a Woolworths moment, i.e. a retail giant going bust. Whilst in the meantime the crisis will at the very least translate into many job losses and the mothballing of many unprofitable stores, the closure of huge supermarkets, something that is unthinkable to most, will likely become a reality as distressed retailers attempt to bolster profit margins by cutting costs by closing supermarkets that are no longer able to operate at a profit. The UK arm of Toys R Us has been teetering on the brink of collapse for several months now, following its American parent company filing for bankruptcy protection in September 2017 that triggered a downsizing program through rapid store closures that are likely to see at least 200 of its 866 US stores close in an attempt at reducing its $5 billion debt mountain, which dates back to its leveraged buyout of 2005 that cost Toys R Us $400 billion a year in interest payments alone, and thus acts as a huge noose around Toys R Us's corporate neck. Look, she's filling it up. What's she do? What's she doing? Toys R Us. Take the trolley off her.
Everything that she likes.
What are you doing, Eliza? What are you doing picking up everything? And you put the trolley back. You don't want a trolley. I'll take her. Go on. So it should not come as much of a surprise that the British arm of Toys R Us, with its 106 stores, could now be heading for at least a similar fate, if not a Woolworths moment, that could unfold rapidly, all within a matter of days, that could see the retailer plunged into administration with a potential loss of 3,200 jobs, the triggering factor of which is the £30 million black hole in its employees' pension fund that the Government Pension Protection Fund is demanding a near immediate payment of £9 million into to cover 3 years worth of past pension contributions, against which the distressed retailer is offering just 1.6 million, and thus the current crises. The key point is that the PPF would be forced to step in if the retailer went bust, and the calculation being made is that if Toys R Us lingers on for instance another year before going bust, then by that time the pension black hole could be twice the size of the current estimate. Fundamentally, it's the same old story of a giant bricks and mortar retailer being killed off by the internet, by the likes of Amazon and a myriad of other online retailers that have sprung up over the past decade or so, against which the bricks and mortar retailers just cannot compete in terms of price given the vastly differing overheads. And the basic flaw in Toys R Us is that the stores were just too big, which is why they are suffering, whilst smaller store retailers such as the Entertainer Toy Shop chain that continues to do well, for now at least. So far, this year's retail sector perfect storm continues, with the persisting dynamics of soaring inflation as a consequence of the Brexit sterling plunge. which in the latest data remains stubbornly above 3% CPI, therefore generating a year-long upwards pressure on shop prices as suppliers restocked at much worse exchange rates that already distressed retailers such as the big supermarkets are delayed fully implementing. And then the retail sector had to contend with stagflation, one of wage growth of just 1.8%, persistently lagging behind even the so-called official rate of CPI inflation, 3.1%, acting to squeeze the purchasing power of worker earnings. However, in reality, actual inflation is far higher, with RPI at 4% and real demand-adjusted inflation at 5.1%. Implying that the UK economy has been in deep stagflation for the whole of this year, one of the real terms erosion of the purchasing power of earnings, i.e. falling demand, which increases the risks of a recession as the economy enters a depressed stagnant state where workers are not able to maintain consumption of goods and services, resulting in economic depression with inflation, i.e. stagflation. In terms of shoppers, well, if Toys R Us does go bust, then one can expect deep discounts in individual store closing down sales, as and when they're announced. In fact, they are going to be closing down sales no matter what happens in respect to the pension fund. It's just a question of how quickly and how many stores closing. At least 1/3 of Toys R Us stores were likely going to close anyway, though shoppers should remember to act fast on store closure announcements, as most of the stock will go fast. Whilst retail stock investors have had a lucky escape because Toys R Us has toyed with an IPO several times over the past few weeks, with 2017 having been seen as the year to float, and could still materialise in some form during 2018. Perhaps an Asia-only stores float without the debt burden could convince institutional investors to play. You're getting pushed, yeah?
Yeah.
For your birthday?
I go home.
Yeah, okay, bye. Bye, Liza. Bottom line is that Toys R Us is just the tip of the iceberg of what I expect to follow during early 2018, as the failure of retailers to perform during November and December will put many into severe distress during January and February as the retail sector crisis continues to unfold.